Nobody rings a bell before a financial system changes. There is no single headline that tells you the rules have quietly started shifting. Most people only recognize the change after their savings buy less, their investments behave differently, and the old strategies stop working. By then, the biggest institutions have already adjusted, and today, one of the clearest signals isn't coming from the stock market. It isn't coming from cryptocurrencies. It isn't even coming from real estate. It's coming from an asset that has survived every major currency, every empire, and every financial experiment in recorded history: gold. If you only look at the daily price of gold, you'll miss the real story. Prices move because traders react to news, interest rates, and market emotions. But beneath those short-term moves is something far more important: long-term demand from institutions that don't think in weeks or even years. They think in decades. These buyers are not trying to outperform the market next quarter. They are trying to protect national wealth against risks that most investors never even consider. That raises an important question. Why would governments, with access to the world's best economists and financial advisors, continue increasing their gold reserves when modern financial markets offer thousands of other investment opportunities? Gold pays no dividend. It has no CEO. It doesn't generate quarterly earnings. Yet many central banks continue adding it to their vaults. Their decision isn't based on nostalgia. It's based on one simple idea: trust can disappear much faster than money can be printed. Over the last several years, governments have watched the global financial system become more politically complicated. Economic sanctions, trade disputes, rising geopolitical tensions, and increasing competition between major powers have reminded policymakers that financial assets are only as secure as the system supporting them. Every major geopolitical event forces governments to ask the same uncomfortable question: what assets remain valuable regardless of politics? For many institutions, gold has become one of those answers. Unlike paper currencies, it cannot be created by expanding a central bank's balance sheet. Unlike government bonds, it carries no promise from another government that might one day change its policies. It simply exists as a physical asset whose value has been recognized across civilizations for thousands of years. Meanwhile, another challenge continues growing in the background: government debt. Across much of the developed world, public debt has climbed to levels that would have seemed almost unimaginable a generation ago. Servicing that debt becomes more expensive whenever interest rates remain elevated. Every percentage point matters, because governments must refinance enormous amounts of borrowing year after year. This creates a difficult balancing act. High interest rates help fight inflation, but they also increase borrowing costs. Lower interest rates reduce pressure on government finances, but can encourage inflation if they arrive too soon. Policymakers rarely have perfect options. Instead, they choose the path that creates the least damage over time. History shows that periods of high debt often lead to gradual changes rather than dramatic collapses. Inflation doesn't need to explode overnight to reduce purchasing power. Even moderate inflation, if it remains above interest earned on savings for many years, quietly transfers wealth away from cash holders. Most people never notice because the process happens slowly. Prices rise a little every year, wages struggle to keep pace, and everyday life becomes steadily more expensive. This is one reason long-term investors pay attention to hard assets. They are not necessarily expecting an economic disaster tomorrow morning. They are preparing for the possibility that the purchasing power of paper money continues changing over the next decade. For them, gold is less about predicting a crisis and more about managing uncertainty. The mistake many investors make is believing every short-term decline invalidates the long-term story. Financial markets rarely move in straight lines. Even the strongest long-term trends experience corrections. Rising bond yields, a stronger U.S. dollar, or temporary shifts in investor sentiment can all pressure gold prices for months at a time. But short-term price swings don't automatically change the structural forces driving long-term demand. That's why experienced investors spend less time asking where gold will trade next week and more time asking why institutions continue accumulating it despite temporary volatility. Price attracts headlines, but behavior reveals conviction. When large buyers continue adding exposure through uncertain periods, they are sending a message that extends far beyond today's market noise. Perhaps the most important lesson is this: financial systems don't usually change through dramatic announcements. They evolve slowly until one day the new reality becomes impossible to ignore. By the time the average investor notices, the largest institutions have often spent years quietly positioning themselves for the world ahead. Now imagine what happens if this trend continues for another 5 or even 10 years. Every month, central banks add more gold to their reserves. Governments continue issuing new debt to finance growing deficits. Inflation may cool for a while, then return when markets least expect it. Interest rates rise, fall, and rise again. But the underlying challenge never truly disappears. The financial system keeps functioning, yet the foundation beneath it slowly changes. This is how major monetary shifts have unfolded throughout history, not through one dramatic event, but through hundreds of small decisions that eventually reshape the entire landscape. One of the biggest mistakes investors make is assuming confidence disappears all at once. In reality, confidence usually fades gradually. At first, people ignore the warning signs. Then they explain them away as temporary. Finally, they accept that the world has changed. Markets often price in that reality long before the public recognizes it. Gold has historically acted as one of the first assets to reflect those deeper concerns because it isn't valued only for industrial use or corporate profits. It is valued because people believe it can preserve purchasing power when confidence in paper assets begins to weaken. That doesn't mean gold moves higher every single month. In fact, some of the strongest long-term bull markets have included painful corrections that convinced investors the trend was finished. Rising bond yields can pressure gold. A stronger dollar can reduce international demand. Better than expected economic data can temporarily shift money towards stocks instead. These forces matter, but they tend to influence shorter time frames. Long-term structural demand follows a different path. Institutional investors understand this distinction. They don't make billion-dollar decisions based on a single inflation report or one central bank meeting. They study long-term fiscal trends, demographic pressures, government borrowing needs, and global reserve management. When several of those forces begin pointing in the same direction, portfolio allocations gradually change. Those adjustments rarely make front-page news, yet they can influence markets for years. Another factor that deserves attention is diversification. Many countries have spent decades holding a significant portion of their reserves in the same major currencies. Today, some policymakers are asking whether relying too heavily on any single reserve asset creates a necessary risk. The goal isn't necessarily to replace one currency overnight. Instead, it's to spread risk across multiple assets. Gold naturally becomes part of that conversation because it isn't issued by any government and doesn't depend on the creditworthiness of a single nation. At the same time, investors should avoid believing that any asset is guaranteed to rise forever. Markets don't reward certainty, they reward preparation. Gold has experienced long periods of underperformance before beginning powerful advances. Stocks have done the same. Bonds have gone through decades of strength followed by difficult years. Successful investing has never been about predicting every move correctly. It's about understanding the larger forces that shape markets over long periods. This is why the debate surrounding gold is often misunderstood. The real question isn't whether the price reaches one specific number. Prices naturally fluctuate. The more meaningful question is whether governments, central banks, and institutional investors continue treating gold as an increasingly important reserve asset. Despite those fluctuations, if they do, the long-term story becomes much more significant than any single rally or correction. History repeatedly shows that financial systems evolve, reserve currencies change, monetary policies adapt, economic leadership shifts between nations. None of these transitions happen overnight, but every transition leaves clues for those willing to pay attention. The investors who succeed over decades are often the ones who focus less on daily headlines and more on structural trends that unfold slowly beneath the surface. Ultimately, gold is not simply a bet on higher prices. For many institutions, it represents insurance against uncertainty in a world where debt continues expanding, geopolitical tensions remain unpredictable, and confidence must constantly be earned rather than assumed. Whether gold trades higher or lower next month is impossible to know, but understanding why some of the world's largest financial institutions continue holding it may be one of the most valuable insights an investor can have. When future historians look back at this period, they may not remember the exact day gold reached a particular price. Instead, they may remember it as the period when governments quietly began preparing for a different monetary future, while most investors were focused on yesterday's headlines. Sometimes the most important signal isn't the loudest one. Sometimes it's the quiet decision repeated year after year by the institutions responsible for protecting trillions of dollars. Those decisions rarely attract excitement in the moment, but over time, they often explain why the financial world changed long before everyone else realized it.